Welcome to The Explainer. Today, we're breaking down a company that's absolutely critical to the modern tech landscape, yet intensely debated on Wall Street. I'm talking about Broadcom, ticker symbol AVGO. While everyone is out there talking about the flashy graphics processing units, Broadcom has quietly positioned itself as the essential backbone, the vital infrastructure of global AI. They're effectively the toll booth of the AI highway, and today we're going to demystify exactly how they've built this empire.
Okay, let's dive right in. Here's our game plan for today. First, we'll look at the AI infrastructure backbone. Then, we'll weigh the bull case against the bear case. After that, we'll solve the valuation puzzle, and finally, wrap things up with future catalysts and our bottom line.
Kicking things off with Section 1, the AI infrastructure backbone.
The fundamental reason we're examining Broadcom today is their undeniable, frankly explosive growth in the artificial intelligence sector. You see, they aren't making the consumer-facing chips, they're building the complex custom silicon and networking solutions that allow massive AI clusters to actually connect and communicate with one another. Without them, the AI revolution literally hits a traffic jam. And that brings us to this staggering number, 143%. That represents Broadcom's phenomenal year-over-year surge in AI semiconductor revenue, hitting a massive $10.8 billion in their latest quarter alone. Alongside that, their net income shot up 88% to $9.3 billion on 48% revenue growth. I mean, they are quite literally minting money as the world builds out AI data centers, totally cementing their role as an unavoidable AI toll booth.
And this brilliantly illustrates the central paradox of our explainer today. By traditional metrics, a trailing price-to-earnings ratio of roughly 70 looks, well, incredibly expensive. Yet look forward and the PE drops to only about 23. That is a massive, kind of confusing gap between backward-looking and forward-looking valuation metrics. It raises the ultimate question, is all of this spectacular growth already priced into the stock?
Moving right along to Section 2, the bull case.
Let's play defense first and lay out exactly why Wall Street remains so incredibly optimistic about Broadcom's future, despite that high trailing valuation. What's really interesting here is the sheer confidence from institutional analysts. The average analyst price target sits between $514 and $519, implying a roughly 23% upside from current levels. JP Morgan goes even further, maintaining a $580 target, which suggests a massive 45% upside. The financial world clearly believes Broadcom has plenty of runway left.
So what's fueling that widespread optimism? It really comes down to three core pillars. First up is revenue visibility. Broadcom has secured ironclad multi-year contracts with a handful of hyperscalers. Think Google, Meta, OpenAI, and Anthropic. This gives them clear visibility straight through 2028. In fact, they project their AI semiconductor revenue to exceed $100 billion in fiscal 2027. Second is technical leadership. Their Ethernet switching technology, specifically the Tomahawk 6 switch and 3.5D XPU platform, are dominant and actively gaining market share. And third, a history of delivering. They've consistently closed these scary PE gaps in the past.
Understanding this historical logic is absolutely vital, because Broadcom has executed this exact high valuation setup before without crashing. At the end of fiscal 2024, their trailing PE hit an eye-watering 37, while the forward multiple sat at 29. Did the stock collapse? No, not at all. Over the following quarters, their earnings more than doubled, the multiple fell naturally, and their market value rocketed from $790 billion to a staggering $2 trillion today. They have a proven track record of growing into these massive valuations.
Now for Section 3, the bear case.
Acting as the prosecution for a moment, we need to inject some healthy skepticism and outline the very compelling risks. Because even after a recent pullback, a trailing PE of roughly 70 is well above the semiconductor peer average of about 55. In fact, some discounted cash flow models suggest the stock's fair value sits closer to $419, meaning it's essentially fully valued right now on cash flow terms. When we look under the hood, we see structural challenges brewing. While previous gross margins sat at a very healthy 77.1%, projections show a drop to 74% for the next quarter. This margin pressure is a real mathematical consequence of their current business model. As AI semiconductors become a larger portion of their mix, they're selling more lower-margin custom silicon, and that drags down the higher margins they typically enjoy from their software division.
Then there's the elephant in the room, extreme customer concentration. The vast majority of Broadcom's AI revenue is driven by just approximately 6 massive hyperscaler giants. If even one of these customers, like a Google or a Meta, decides to moderate their spending or shift their data center strategy, the impact on Broadcom would be severe. They're highly dependent on a very small group of very large checkbooks.
Because of this dependency and their high valuation, the stock is currently priced for absolute perfection. Recently, Broadcom guided for $16 billion in AI revenue for the next quarter. That is an incredible, massive number, but it slightly missed Wall Street's astronomical whisper number. The result? A sudden 12.6% drop in the stock price. Investors expected an upgraded long-term outlook, and when it didn't come, they severely punished the stock. At these levels, any failure to vastly exceed expectations is risky.
Section 4. The Valuation Puzzle.
So, we have Wall Street analysts projecting massive upside, yet we have very real risks of margin compression and sky-high expectations. It's time for us to act as the judge. The whole case really hinges on this single question. How do we reconcile a 70x trailing multiple with a 23x forward multiple? On a forward basis, meaning what the stock costs relative to next year's expected earnings, Broadcom trades around 23 to 27 times. That isn't obviously expensive for a company growing AI revenue at triple-digit rates. Actually, their PEG ratio sits at 0.47, suggesting the stock might even be undervalued relative to its growth. So why does that trailing number look so terrifyingly high?
The secret here comes down to amortization charges. Broadcom is famous for its massive acquisitions, like their major purchase of VMware. These acquisitions create large, non-cash accounting expenses that temporarily suppress their officially reported earnings. It makes their profit look artificially low on paper, which in turn makes their trailing PE ratio look artificially bloated. But here's the key to the puzzle. As those charges fade over time, reported earnings naturally rise toward their actual adjusted numbers, closing the gap organically.
And that brings us to a fascinating historical precedent that you should absolutely take away from this. Twice in the past 5 years, Broadcom has faced this exact same gap between high trailing multiples and lower forward multiples. And as this quote perfectly highlights, both times, earnings rose to meet the price, not the other way around. The stock didn't crash, the earnings simply caught up. To make this happen again, analysts expect a massive 82% earnings per share growth to $10.24 by fiscal 2026. That is the massive bet investors are making today.
Finally, Section 5, Catalysts and Bottom Line. Whether you're currently holding Broadcom shares or you're thinking about stepping in as a new buyer, here are the specific milestones you must watch to see if this growth narrative holds up. Step 1. Monitor their upcoming earnings closely. Specifically, keeping an eye on that September 2, 2026 target where they need to beat that $16 billion AI revenue guide. Step 2. Track their gross margin trajectory. If that 74% projection proves to be conservative and they beat it, that is incredibly bullish. And Step 3. Watch closely for any new hyperscaler contracts. Any fresh deal or customer update provides immediate visible upside.
Bottom line, Broadcom is a phenomenal business. They're dominant in their niches, generate strong cash flow, and are the undeniable toll booth for the AI revolution. If you believe in the AI infrastructure build-out, that forward PE of roughly 23 offers a reasonable entry. But as we've seen, the margin for error is razor thin. Any sign of spending moderation from their top clients will absolutely hammer this stock. So I leave you with this final provocative thought. Broadcom is clearly priced for perfection, but in the rapidly changing, highly volatile world of AI, is perfection a sustainable standard? It's a fascinating risk-reward balance to consider. Thanks for joining me for this explainer, and keep learning.